Hi, one of the most common questions I get is when do I sell? And so in this video we're going to explore that, and I'm going to show you how we are analyzing this market to see when gold and silver have their highest valuations against other asset classes. And so I'll just get right into it here. I'm going to show you the three indicators that we have disclosed to the public. We use many indicators. Some of them are fairly complex. Some of them even break down into a group of data sets and indicators that we make a composite of. And so, but the three that we can disclose to the public that I've talked about before are the gold real estate ratio, the Dow gold ratio representing paper assets, and the gold silver ratio as a confirming indicator. So what you're looking for is for the fundamental indicators, the gold against paper assets like stocks and gold against real estate, to be in a certain range, and then for the gold-silver ratio to spike, which would happen when the public comes rushing in at the end of this bull market. When they bid the value of gold and silver up wildly, just like they did in the last couple of weeks of '79 and the first few weeks of 1980, gold starts to become too expensive, and the public shifts their preference towards silver just because they perceive gold as being expensive. When they start buying a lot of silver compared to gold, silver's value rises compared to gold's, and the gold-silver ratio will make a big spike. And that's a confirming indicator. So you've got these two primary indicators already in a certain range, and then you're looking for that gold-silver ratio to spike. So here we go. This is Robert Shiller's U.S. Home Price Index, and this is the data set that he uses that goes back into the late 1800s. It's, you have to be very careful when you're doing this. You can't use two different data sets, one for the 1980 price and then calculate off of a different data set for today. There's a lot of different data out there, and the results vary wildly. But if you use the same data set from 1980 to today, you'll get some pretty predictable results. But like I said, it's important to know the data that you're looking at. This data goes back a long ways past what we're showing you here. That's one of the reasons that we use it for a lot of things here at goldsilver.com and Hidden Secrets of Money. One of the things about this data, though, is it represents only 4 cities in the United States. This represents Atlanta, Dallas, Chicago, and Oakland only. So when it comes to showing the recent real estate bubble, where were the cities that had the biggest bubbles? They were cities like Las Vegas, the major cities in Florida, Los Angeles, New York City. So they were major metropolitan areas. If they had put the city of San Francisco in instead of the city of Oakland, the results would be very different than this. Also, this is quarterly data. A lot of people make the mistake of looking at one set of data or another, and when you change this in 1980, gold hit a peak value to where it only took 118 ounces of gold, but this quarterly data averages gold's price. So the high in this data is only $548 for gold. Gold hit $850 in 1980, not $548. And then it shows that we came up here to $129 back when gold peaked in September of 2011. And we've now, if you correct this data, those peaks are 88. So if we plug in the daily data and the high of 850, we get 88 ounces of gold to buy a single-family median price home, and 119 was the peak when gold hit 1900 there. And we're back down to 185. Well, what we're going through here is just our version of this 1975 to September of '76 pullback that we went through there. We're doing the same thing now, and But then gold went from $100 an ounce, 103 I believe it was, all the way up to 850. And that's from September of 76 to January of 1980, so just a few years. If you took that same move today, you'd be up here at maybe 45 ounces of gold or 40 ounces of gold for a single-family home in the United States. And so you're looking for something that's going to be over the 88 ounces of gold there. Now, I was just looking at a bunch of different data. If you use the U.S. Census data on new homes, you end up with the 1980 high being 74 ounces of gold. If you use the data from the census that's taken every 10 years, that's incorporating all homes sold in the United States, and that gives you an average to where the 1980 high at 850, gold bought just 55.5 ounces of gold, bought a single-family median price home in the United States. Now we're going to get to the Dow Gold ratio. We use the Dow Jones Industrial Average, which is a composite of the 30 largest industrial companies in the United States, as a proxy for stocks, for paper assets. And then we just take every day or every month here, we just divide it by the price of gold. And we've got data here going back to 1896. And what you see is that it goes through a cycle. And there is a fair value that's very easy to see when you look back a long time ago. But as we get into a system, a monetary system that is manipulated by men, it gets harder and harder to see where the average really is, where the mean is, where everything's in balance. But this is the fair value. When you get up in this range, you're getting into overvalued territory where gold is buying too many paper assets. So this is the caution range. Right now, we are a long ways away from this. There's nothing to worry about currently. But when we get to the point where gold's price is about 1/5 of the points on the Dow, that's in the 1/5 to 1/4 of the points on the Dow is fair value. When we get to 1/3, that's the area where I'm going to be watching this on a daily basis instead of just looking at it once in a while. There's nothing to worry about right now, so we're a long ways off from this peak. When it gets to where gold's value is half the Dow, in other words, it takes 2 ounces of gold to buy 1 share of the Dow, that was the peak in the Great Depression. And so that's where you wanted to sell under a deflationary scenario. If this turns around and goes into an inflationary scenario, we're looking at something very much higher than that. Or if we go into a currency failure or a major currency crisis, we're looking at something very much higher than where gold's value is half of the points of the Dow. So this is the range to sell in, I believe. And so it's from 2 to, in 1980, there was a day where the price of gold and the points on the Dow were the same. I am expecting, though, that we're going to go beyond that because I think we're going into a currency crisis that's going to be happening while all of this happens. I really think a good target is like half an ounce of gold. What's interesting here is that top line starts right about when the Federal Reserve was created. And so we went on this man-made monetary system that doesn't have the automatic balancing mechanism that gold had. And as we go off of gold more and more, you see these swings become more and more wild. This is basically just like a top starting to wobble, and the wobbles get bigger. This is a man-made monetary system going out of control and going into an eventual implosion. I really do think that you're going to see a peak somewhere way up in here. And so what we're looking for is the gold real estate ratio for gold to exceed its value against real estate that it had in 1980. And then this to also be up in this range at the same time. Here's another interesting fact that if you pick 2 ounces of gold and higher to sell at, in 1980, you could have taken a full year and sold 20% of your gold, and then 20% of the remainder, and 20% of the remainder, and 20% of the remainder, and 20% of the remainder. And you could have done this 12 times. There was more than a year where the Dow-gold ratio, gold's value, was greater than half the points of the Dow. So this is basically our exit strategy, is to sell these increments around the top and then go into the next asset class, possibly high dividend yield stocks. I'm hoping it's cash flow real estate. But we do have a long way to go from today, so right now is just a buy zone. There's nothing to worry about yet. But if you want to do these things on your own, this is the way that this is the way I am using to calculate when I am going to sell personally. So I want to see gold above this 2 level. In other words, its price will be greater than half the points of the Dow. I want to see real estate where gold's value is greater than its 1980 high against real estate. And then the real sell signal comes when the gold-silver ratio rises and flashes sell. All these charts are inverted, so the zero line is up here, so that this is showing gold or silver rising against those other assets. Right now, the gold-silver ratio is way down in the 60s here. This ratio, if you look back, this goes 16 to 1, 15 to 1. So basically, silver's value was 1/15 of gold. I've got a chart going back to 300 BC. Now, when you go back that far, there aren't very many data points. You're getting, and you're getting data points from one area of the planet or another area. So, but the average going back is 12 to 1. So what I'm looking for is once the gold-silver ratio gets up near 20, and if those other 2 indicators are in their sell zone, this is the confirming indicator that it's time to sell that first 20%. If it gets to 15, another 20% of the remainder. If it gets to 12, another 20%, and so on. 10, 8. I don't know if it's going to go to 8. But selling around this peak in these increments is probably the best way to catch the top. And I really do think these things are quite measurable. And this is a key, using the gold-silver ratio as confirmation that it's time to sell. Because if we're going into a currency crisis and real estate and gold are already high, the ratios are already above where they were in 1980, they could go a lot further. I mean, you just don't know how high the valuations are going to go. But when all 3 of them line up, then you have a definite signal that it's time to move into the next asset class and reap your rewards. Now, you can do this on your own. Make sure that you use the same data sets to measure from 1980 to today. And there's a lot of data sets out there, and then you have to look inside look at the spreadsheet that the data set comes in and see whether it's daily, monthly, or yearly data, and then correct the month or the quarter or the year to the peak. Like for instance, on Shiller's data, I showed you the data quarterly and then corrected to 850 as the true high in gold. And then if you find this complex, though, this is what we do for all of our insiders. And insiders are anybody that buys the insider program for the price of an ounce of gold, or you can just buy 10 ounces of gold or 500 ounces of silver, and you automatically become an insider. And so when we do it also, we're using quite an array of different indicators. These are some of the fundamental ones. There's several other fundamental indicators, and then there's also confirming indicators that may or may not flash correctly, but we're looking for a certain percentage of these things to all line up. So if you're going to do this yourself, good luck. I believe you're armed now with some better information than perhaps you were before. If you're an insider, thank you very much for supporting us, and we'll see you in the next video.